Okay, welcome everyone. My name is Sandesh Pangerkar. I have conducted the last session and this is my second session in the group called as Middle East Quantity Surveyors Association, MEQSA. I established this group with a number of purposes which I have explained already on the group, so I'm not going to repeat those. Today's topic is project finance, control and reporting. This is one of the core competency which those who want to become MRICS or member of RICS or chartered surveyor, they need to achieve this core competency in the QS and construction pathway at level 3. Core means at level 3. So we are going to study this competency from that perspective. Hopefully this session will be a great help to those who are going to be MRICS or who are on their path to become MRICS. So before sort of starting the session, those who are new, this is my brief profile. I have done my MBA from UK, from University College of Estate Management. Basically, I'm a mechanical engineering. Long time back, I did mechanical engineering from India. I'm fellow of a number of institutions, including RICS, Chartered Management Institute, and Chartered Association of Building Engineers from UK. Member of Chartered Institute of Arbitrators and Chartered Institute of Building UK. I'm also RICS APC chairman and assessor, and I have done the RICS accredited civil commercial mediator course. So I'm actually RICS accredited civil commercial mediator. Currently, I am based in Doha, Qatar. I'm also sort of director in the company called David Adamson, leading and I have established in 2015 the India operations of the company. I have over 19 years of professional experience, mainly in post-contract, and that's why I am probably best suited to take this particular competency. Currently, I am leading a multi-billion project on a multi-billion project post-management, post-contract commercial team. And I'm also sort of involved in a bit of arbitration, which is happening in London of that particular client with the previous contractor. So without wasting any further time, let's start today's session. So we are going to look at RICS description of competency, RICS level 1, 2, and 3 requirements, RICS APC reading list, expected questions which can be asked about this particular competency, and we'll conclude by the question and discussion session between us. In the RICS APC reading list, we will have post-contract cost control, change control procedures, cost reporting, cash flows, valuation final account, claims, loss and expense, risk management, value engineering, benchmarking, best value. We are going to touch upon these subjects. So RICS description of competency. Now you can see, as the name suggests, the name of the competency is project finance, control and reporting. So it is about controlling and reporting processes used for the project finance, as simple as that. Now when this happens, this generally happens post-contract, post-award of the construction contract to the contractor. So this competency covers everything which relates to managing the budget post-contract. So that's what RICS says. In the context of construction sector, this competency covers the effective cost control of construction projects during construction. Candidates should be aware of the principles of controlling and reporting cost on any construction project. See this, a lot of people ask me question. I have never done post-contract role. So will they ask me questions about post-contract? Yes, they will ask because the competency expects. But if you have never done, and if you have not written this particular aspect in your summary of experience, then the questions will be based on the principles. They can understand that you have particularly not sort of had experience this particular aspect. Still, there will be questions on the principles of controlling and reporting cost. And if you have experience, then you are supposed to have a detailed understanding of the control and reporting processes used on your particular project. So this is RICS expectation of the competency. It's better to understand what RICS expects so that you will be prepared for that. RICS level 1, 2, and 3 requirement. Now, last particular webinar, I explained what is level 1, level 2, level 3 for those who are sort of new to this whole process. So level 1, as I mentioned, it's about the knowledge and understanding. So you need to demonstrate the knowledge and understanding of effective cost control during a project, legal and contractual constraints on a cost of a project, effect of time and quality on a cost of a project. At level 2, you are supposed to have sort of applied your knowledge in preparation and presentation of financial reports, effective forecasting of cost, risk, and their financial implications. And at level 3, you should be able to advise your client. The client can be your contractor if you are a subcontractor, or the client can be the employer if you are a contractor. So you should be able to advise on strategies and procedures to control predicted expenditure in line with budget. And this is what RICS suggests as the APC reading list. All this you can find in the manuals which I shared on the group. So what RICS expects you to know about post-contract cost control, change control procedures, cost reporting, cash flows, valuation, final account, claims, loss and expense, risk management, value engineering, benchmarking, best value. I'm going to cover all of these topics now one by one through the next slides. Post-contract cost control. Now, as I mentioned, what is post-contract? Post-award of the construction contract. What means cost control? Now, please understand these concepts very clearly. Anywhere, if you see the word control, anywhere, not just in the context of this particular subject, anywhere, the control word normally is used in management principles. The word control means you have something which is sort of plan. So you have planned something, and now you are looking at the actual situation, and if there is a variance between the two, then you need to analyze that variance and you need to sort of act upon it, how that variance can be reduced or can be eliminated. In context of this particular competency, what it will be, your plan is your budget, the construction budget. The client will have a particular budget, and your variance is due to a number of reasons. If there is a delay on the project, if there are variations introduced, or many number of reasons. So what cost control does is basically looking at the variance and trying to address how that variance can be sort of minimized, or how we can sort of manage that variance. Does not necessarily mean always it has to be minimized. So what RICS suggests, post-contract cost control covers all financial matters post-award of a construction contract in administering a construction contract. So if you are a QS typically working in post-contract, then what's going to happen is there will be preparing of interim valuations, change management, cost report, cash flow forecast, final account. You will be involved in these type of activities in post-contract. Now I'm going to ask you this question. If you are a QS working on a post contract, what measures you are going to take to effectively control costs during construction? Please comment. So some people are saying cost plan preparation, claims, change material wastage, control material wastage, procurement control, materials mainly, payment, cost control function. Okay, good. So the measures to be taken effectively to control costs during construction and especially post contract would include all of that what you stated. So mainly it will include how you will manage the whole change control process, how the changes will be managed. Then what about the risk? How you will mitigate the risk? So risk management is another aspect. Then regular reporting of cost is important to the client, whosoever your client is. So that's another aspect of the one of the measures which will effectively control the cost during construction. Also the regular updates of cash flow, etc. So all of these points you need to sort of addressing. Implementing a robust change control process, as we mentioned, proactive risk and contingency management, management of provisional sums within budget, regular cost reporting, which is also forward looking, rolling final account and closure process for impact of change. You should always be having a rolling final account of the project. You don't keep the things pending for a long time. So that is one of the important aspects if you want to effectively control costs during construction. Now another question for you. How will you report forecasted costs throughout the life of the project? This is where your practical experience comes into play. So please comment, how would you report the forecasted cost throughout the life of a project? Yes, good. Preparing outturn cost, job cost reporting, cost report. Yeah, that's right. See, reporting forecasted cost, normally there will be a monthly report done by the quantity surveyor Again, whether it is from client organization or the contractor organization, doesn't matter. So there will be one sort of monthly report which will be prepared, through which you will be reporting the forecasted cost throughout the life of the project. So these are some of the concepts which on which there will be initial sort of level 1 questions will be asked. Now, change control procedure. Why is change control required? What exactly you mean by change control, and why that is required? Any idea? To find the cost, budgeted cost for variation, potential, and to understand the time and cost impact. Right. So to provide a method of assessing and managing change by estimating not only cost, program and scope effect. So when you raise a change, or somebody raises a change proposal and it reaches to a stage where it becomes a variation order or change order, then it's not only affecting the cost, it may affect the program, it may affect the scope. Scope, definitely it is going to affect if it is a variation in scope. So to provide a method of assessing and managing change by estimating the consequent cost, program and scope effect. And also the client should be made aware of the consequences of the potential change and the effect this will have on overall project cost. Why? Because he wants to take an informed decision. He will only be able to take an informed decision when, as a quantity surveyor, you will be able to tell them about the consequent cost effect. There will be planners who will be able to tell them about the consequent program effect. There will be designers or some other technical people who will be able to tell about the scope effect. So client will have all these parameters, what is the effect of that particular change, and then he will take an informed decision whether he wants to proceed with that change or he doesn't want to proceed. And what legal and contractual constraints might influence project cost? What do you think? Legislation, for example, authority changes, correct? Legislation is what? Legislation is basically law, any regulation change. For example, planning and building regulation, if they change, then there is going to be an effect on the cost of the project. What about other contractual constraints? Say, for example, design risk allocation. If there is a problem in design or design change is required, that is going to have an effect on the project cost. Similarly, there will be cost risk allocation. If there is an incorrect cost plan or there were problems in the cost plan, then that is going to have an impact on the cost of the project. And other contractual risks, if the project encounters delay or if there is faulty material delivered on the project. So all of these issues are going to result into change in the cost of the project. So these are some of the constraints which might influence the cost of the project. When can a contract sum be amended? How you can amend the contract sum? Any guesses? Scope changes, de-scope, variation, approval of variation, right? So scope changes. Scope changes is one of the area. Now there are also non-scope change variations. Also there could be expenditure of provisional sums. There are provisional sums in the contract which are expended with the client's instruction. That will result in the variation because that would be normally going through the change management process. What about extension of time? Will that not result also in a contract sum amendment? Yes, that can result in the contract sum amendment if there is an associated cost impact with the extension of time. Also, there could be claims from contractor. Claims like delay claims or claims like the efficiency of the contractors working has changed. So that particular claim, so that is called disruption claim. So there will be claims. There could be penalties imposed by the employer. If the contractor is in delay, there could be penalties, or sometimes there could be what you call as LADs, liquidated and ascertained damages. So these are the areas, or these are the points which you can mention if somebody asks you how the or when the contract sum will be amended. What issues will you consider in advising the client on change control strategies or procedure? Now, what happens if this sort of question is asked by an assessor in an RICS interview? then normally people would get sort of a bit, uh, I would say they will get a bit upset because the word strategy is there. The moment people hear these big words, they get upset. Okay, they are not able to answer. Now, always go back to the basics. Basics is think about what the change control procedure is. You are going to the on a new project, and the client is asking you, okay, now we are in post contract. How would you manage, or what issues you will consider in advising me on the change control strategy? How would you advise me? What advice you will provide to me? So this is kind of a level 3 question. So what do you think? What advice should be provided as a beginning? This is, you are new on the project. What sort of advice you would provide to the client? Minimize changes, notification. See what the question is on change control procedure. How or what issues should be considered in the change control procedure or in the strategy? So this is a bit at high level the question is being asked. So the expected answer can be, one of the answer can be, now you are going to the client. First thing you need to ask to the client, what are your objectives? Mr. Client, what are your objectives? What is your main purpose in having the change control process? Different clients may have different objectives. Some may not be worried about the cost. They want a top quality project. Okay, so they may see things differently. Obviously, everybody will talk about cost, time, and cost, time, and scope, but there will be different sort of priorities given by different clients. So, what are the clients' objectives in the change control process? Okay, then the next question you will ask is, who are the key decision makers? If you want to start the change control process, who is going to authorize the change? In a bigger project, there will be a design manager who will be authorized to design changes, who will be authorized to process the design changes. There might be an end user who might be authorized to, only one person who might be authorized to process all the end user related changes. So you need to ask the question, who are the key decision makers in the process? Then what are their respective level of authorities? Authority means not everybody will have same authority. A project manager may have a certain an authority up to certain limit. When I say limit, it might be a cost limit, it might be a program limit, it might be a scope limit, above which he needs to go to the client, or there might be a contract administrator who might have a particular not contract administrator generally, but who might have a particular level of authority. So different people will have different level of authorities. So that you need to understand at the beginning. What are the level of authorities with the different people? Then who will raise the change proposal? Change proposal means the initial change request. Who will raise it? Will it always be through the contract administrator, or will it be raised by different departments? For example, if you are on a hospital project, there can be an end user already, end user like the people or the company who will be operating that hospital. So they will have their own requirements, and they may introduce the change. So if they are introducing the change, or they are raising the change proposal, will the requirement obviously it will come from them, but will that particular person have authority in that, or will it be only responsibility of the contract administrator to liaise with everybody and to raise the change proposal? So this is one of the question you can ask. Then what will be the funding of the changes? Will it be from a particular funding, or will there be different funding used? So that particular question you can ask to the client. So these are some of the high level questions you need to set up initially before going into the details to set up the change control procedure. And then how the changes will be sort of routed through the contract. Will there be instructions issued to the contractor? Will there be clarifications through RFI? All this you need to sort of understand at the beginning. So these are the points which you can advise to your client. Actually, by asking questions to the client, you can advise on some of these points. So let's see what we have here. Client's objective, who are the key decision makers in the design and approval of changes? Then what are the respective level of authorities, trigger level of authorities? What is the procurement process, and how this will affect the change control? Different procurement process may have a different impact on the change control process. Then what about the confirmation from client or project manager of what cost needs to be included? Now, in some cases, There will be only construction cost, that is what is expected of a quantity surveyor. But in most cases, the client will also ask for looking at the professional fees also. So if there is a change introduced on the project, what would be the impact on the professional fees? So there is a possibility because of that change, the consultant fees also may need to be increased because there will be longer duration for which consultants will be there. Then who takes the responsibility of raising the change proposal? Is it dependent upon the type of change, as I mentioned? How will the change control procedure link with contract instruction and contract procedures during the construction period? So these are some of the issues they will expect in advising the client on change control procedure. How will you actually implement the change control procedure? Now imagine that all these issues you discussed, you got the answers from the client, okay, some key people. Now you want to implement this procedure. You have understood what needs to be done. You want to implement this procedure actually into the project. How will you do it, or how you have done it on your project? Answers, please. Okay, somebody is saying prepare a flowchart. Good. So I would say as a beginning, again, this might sound a difficult question. The answers are actually simple. So you have discussed the procedure only with the key members of the client team. Now what you need to do is you need to go back and communicate this procedure to the rest of the team. So communicate this procedure. How you can communicate the procedure? Normally a report would be done, or you can also in that report itself you can actually include a flow chart, or you can communicate it through flow chart as somebody mentioned. You can also include this procedure in something called as project execution plan. So these are some of the ways how you can communicate the procedure. So that is the first step, communicating the procedure to the rest of the project team. Then what you will do, you also need to sort of issue them the pro formas as a contract administrator or as a QS. In some cases you need to issue them the pro formas of the change request proposal. They need to have some formats. Normally these formats can be issued by the client, or they would expect a QS company to have their own formats also. They might ask, do you have the format? Okay, so you need to issue the pro formas of change request proposals to the other team, or change request form sometime it is called. You also need to arrange regular change control meetings. You need to maintain a live log of the change control process, and you need to ensure that the implementation of the change control procedure is strictly followed. Otherwise, the project normally will try to lose or try to derail with respect to the changes. So maintain a change control log, ensure that properly and timely change control procedure is followed. So these are some of the expected answer when you are trying to implement a change control procedure. Normally these answers are worded from a perspective of a client, which is employer, and a consultant QS working for the employer. But more or less the principles will remain even if you are from a contracting side, because in that case your client may be the contractor, senior person in the contracting department itself. Now let's say you have issued the process. Everybody understands now how this process follows. Now you have been tasked to prepare a change control proposal or change request or change control form. Normally there will be input from a number of people, but you as a contract administrator or you as a QS might be in charge of sort of managing this process. So in a change control proposal or change request or change control form, what information you will include? What do you think? As a minimum, description of the proposed change, initiator, drawings, BOQ, specs, type of change. Very good. So all that is description of the proposed change and why this change is required, reason for the change, because people need to understand why this change is required. What else you will have? Obviously, if the change has an impact on scope, you need to mention what that impact is, and if there is any adverse impact, then what that impact is on other aspects, because some change may be required, it may have an adverse impact on some other aspect of the construction. Then cost, as a QS, definitely cost comes. So you will tell them that what is the cost. Normally the word used is rough order of magnitude of cost, ROM. So what is the cost of that particular change, and what impact it will have on the overall project cost, how the cost will increase, etc. sometimes it might be saving also. So what is the impact of the cost, impact on the cost? And also you need to explain the basis of how you have arrived to that cost. You cannot just tell X, Y, Z or 100,000 is the cost. Okay, you need to attach with that the basis how you have arrived to the cost. Similar to the cost, you need to have the impact on this program. If the program is affected, to what extent the program will be affected. Again, here you need to show you are working. Now in this case, you as a quantity surveyor won't be doing it, you will be getting it from a planner. Okay, so that you need to mention if there is any scope impact, if there is any cost impact, if there is any program impact. Then you need to mention what is the effect of this particular change on the design fee of the other consultant, or the in general the project resources. If will there be any impact on the project resources, and what that impact will be. Also you need to tell people how important is to have this change. What happens if this change doesn't proceed? So what are the effects if this change doesn't, if this change is rejected, let's say, by someone? So that needs to be told. You also need to be telling them that how much in how much time you expect the approval of this change, because sometimes the form goes and it goes and goes and nobody comes back. So you need to indicate that we need an approval of this particular change within 7 days, otherwise these are the impacts. And also there will be regular things like there will be approval box, etc., etc., signing box, etc. So this is all what you need to include in a change control proposal. Cost implication, as we said, any risk attached to the proposal, implication on functionality or quality or scope, program implications, supporting documents obviously we will include, as I mentioned, implication to project team fees and resources, source of funding, where is the funding coming from, whether it is coming from contingency, provisional sum, additional funding, etc. Implications of late approval and or rejection of the proposed change. Most of you answered most of these points correctly. Now this is an example of a change request form on the left, and on the right there is an example of a variation order, a typical variation order. The formats may differ, but in principle these are the items. So if you see at the left hand side picture, it is a change request form. Now on different projects there will be different terminologies used. So change request is one of the terminology, change proposal form is another terminology. So try to understand the basics of it. Like what is it? Basically this is a form through which a change will be initiated on the project on the client side first, and once it is approved, then maybe if it is a change to the contract, then it will be instructed to the contractor. So all what we said is included here: the effect on the cost, effect on the schedule, the change type, where is it initiated from, the justification behind this, etc., etc. Also somebody has mentioned the sustainability, safety, operational, IT impact of the change, and then the approval process. Variation order, once something is instructed to contractor and it is accepted by both parties that it is a variation, and the variation sort of cost and time impact is finalized, then a variation order will be issued by the client to the contractor. A typical variation order will have minimum details. It will have original completion date, if there is an impact on completion date, original contract price, if there is an impact on contract price, what that impact is, and then brief description of the variation order and the signing by both parties, authorized representative, client and contractor, or contractor and subcontractor, as the case may be. So number of comments have come. Let me just have a look. Is there any request in change request and variation order? Again, different people use different terminologies. Change request is mainly used for something which is initiated through the client organization. Now contractor at this point is not aware of this. Through client organization, there is a sort of initiation done by one of the team. Let's say the end user decides that I don't like this particular department which is there, and I would like to change the orientation of the department, or from a functionality perspective it doesn't seem that the current design, the current contract design is working. So he will raise, the end user will raise the change proposal or change request. So that is normally a terminology for what is initiated at the client side, and once the change request is approved within the client organization, then an instruction will be issued to the contractor. That also will be called as change request most of the time. Once that instruction issued, the contractor will then confirm his time and cost impact against that instruction. There may be a discussion between the client quantity surveyor and the contractor's quantity surveyor. At some point in time, the cost impact and time impact of that particular scope change or variation will be agreed, and that then a variation order will be issued. So that's generally the difference. But again, people use different terminologies, and there is a possibility that now, for example, in one of the project I was there, they used to call change order for a change to the consultant scope, and they used to call variation order for a change to the contractor scope. Both are variations to the scopes only. For consultant, they used to call change order, and for contractors, variation order. So different terminologies are there. As long as you understand the basics, that should be fine. So let's move from the change topic to cost reporting topic, which is second major topic, as the name suggests, of this competency. What is cost reporting? Cost reporting is reporting of the cost to the client. But how that reporting should be? It should be a proactive reporting. It is not just what the basic minimum you know. The reporting should include everything you know, everything which is expected. Okay, so it's not only solely limited to the written instructions which have been there. Okay, if you know that already there is a change coming and it is going to be instructed soon, then this report you are going to produce, assuming that this report you are going to produce from a client or in the client organization as a quantity surveyor, say consultant quantity surveyor, is issuing this report to the client. In that case, he would already be knowing some of the changes which are yet to be instructed to the client, or there might be some issues which will have financial implication. So when he is preparing the cost report, he is supposed to include all these issues, because what finally we want a cost report to include a figure which is almost at that point in time the best estimate of the project's final account. So it has to be something which has been cost managed, because again, as I mentioned, the purpose of the cost reporting is to make your client aware of the outturn cost of the project at all times. Okay, now there are some important things to remember in cost reporting. When you are preparing the cost report, it's important that you need to mention what the cost report is based on. Sometimes you have some basis that the cost report is based on at this date, all the issues known at this date have been taken into account. And then you may have, for example, a figure from somebody else which has been given to you. Let's say XYZ consultant's figure is there, which you need to include as part of your cost report. Then in that case, you need to mention the basis. So this figure has come from XYZ consultant through this email or through this letter reference so and so. So you need to mention the basis, assumptions, and exclusions in the cost report. If you have excluded something, then you need to mention that clearly. All of this needs to be done so that the client exactly gets the idea of what is included in the cost report and what is excluded in the cost report. Also, generally, it is good idea to prepare a draft cost report, discuss it with key members of the client team, and then release it so that people don't get shocked, they don't get surprised. So this initial discussion will also help you. If they have any comments, they can raise their comments. If you think their comments are valid, you can incorporate those comments into your cost report. You can modify your cost report if you, as a quantity surveyor, feel that it is appropriate. So this is sort of the background. This is the management skill which is required in the cost reporting. So it needs to be taking into account everything which you know, everything which is expected to be coming, so that the cost management can take place and the client can take informed decision. And also you need to discuss with the project team or the key members of the project team, at least at the before releasing the final version of the cost report. Also, when you are releasing the cost report, it is important that the cash flow is updated regularly. So that cash flow updates is also required. That cash flow updates is important from a client perspective, because he needs to have that particular amount of money at those particular dates which you have mentioned in the cash flow. That particular amount of money needs to be there in the bank. So these are some of the important aspects of the cost reporting or cash flow. So a question might be, what is the importance of financial reporting and control procedures? What do you think? Partly you have answered this question before. What's the importance of financial reporting and control procedures? First of all, this is a record, isn't it? So when you are issuing monthly cost report, it's a record. So for recording purpose, it is required. And also it captures the project cost. It provides a outturn final account. And also from cash flow perspective, it is important for the client to have that money in their account. So this we will sort of go into a bit of detail of some of the reporting and control procedures and preparation and presentation of financial report through next slides. Reporting and forecasting costs from different procurement routes. We'll touch upon this subject. This is probably a simple question. Establishing reporting regimes protocol, which I just mentioned, that you need to sort of decide, you need to discuss it with the key members of the project team. Using cash flow in financial management. So why is it important to have financial reporting control procedure? I think we looked at this question before. To monitor actual cost against budget, as I mentioned, controlling is monitoring against the plan. To assist in commercial administration and to have formal records. Purpose of cash flow in financial management. So what's the basic purpose of cash flow? You mentioned that it is required for the project forecast or projected forecast for clients funding. Do you know any other purpose of cash flow? Anybody? In chat box? No, financial reporting, cost reporting is same. Yes, somebody said, Prashant Shinde. Yes, progress. Exactly. So the second purpose for which the cash flow can be used is because, see, at the beginning of the project, the contractor may provide you a cash flow, which is a planned cash flow, that this is how he is going to work. This is going to be his rate of progress. And if there is any change in that, you can actually get it from the cash flow also, because this was the planned cash flow. And if contractor is not spending that much amount of money, which you will know from the actual cash flow, then yes, that's an indication of program management tool. However, there needs to be some there needs to be a sort of a detailed analysis of the cash flow before arriving to the conclusion that the contract is really behind the program, because there can be claims, there can be delays, and there can be other things. But yes, in principle, it can also be used as a program management tool. Reporting costs for different procurement routes and client types. Now, sometimes they might be asking, what happens if the procurement route is different and different client? Yes, the answer is simple. If there is different procurement route, the basic principles of cash flow, the basic principles of reporting will remain the same. For different clients, obviously there could be slightly different formats. For different procurement route, also there will be different format, but the basic principle remains the same. Now, somebody asked me through comments before that, can you show an example of a cost report or financial report? Both are same. So here is an example. You can see on the screen that it would include basically three major elements: budget, which is pre-contract, commitment post-contract, and expenditure. Now budget, and this is for different packages if there are various packages on the project, or this can be for one particular contract if there is one particular main contract which you are managing. So this is how the cost report generally would look like. Now budget pre-contract, you can see from initial budget it can be tracked up to revised budget. That may include if there is a budget transfer from some other department, or there is budget transfer from the client, if there is a change in the budget, because sometimes there is, in Qatar there is Ministry of Finance and with some projects, government projects. So if there is change in budget. Commitment would include what commitments have already been made for that contract. So already the contracts placed, if there are contracts pending yet to be placed, those it will include. Agreed variations, even pending variations, because what you are reporting is a outturn project cost. What would be the expected final account of the project? So variation, even if they are yet to be agreed, they will be included. If there are any claims from the contractor, and if you think there is any merit in that claim, then that particular element you can include. If there is anything else left, what we call as estimated cost to complete, then that would be included. So all of this adds up to forecast final cost or expected final account of the project. The variance can be tracked from the budget, like budget and commitment post contract, what's the total of those two and what's the variance. Then expenditure also will be tracked. Expenditure means the valuation or payments as the client wants. So you will generally include what is the gross certified amount to date, what is the retention, what is the net certified amount, so gross minus retention, what is the actual paid amount to date cumulatively, and what is the actual paid amount in that particular month. So this is a typical format. There will be slight modification from a different client perspective, but this is the basic input which is there in the particular financial report or a cost report. I hope this is clear. Now let's move on to valuation or final account. Now we don't have enough time to cover everything which is related to valuation, because valuation itself is a topic for which 2 hours easily I can talk. Okay, so we are not going to touch upon each and every aspect of valuation, and some really becomes tricky, some of the aspects depending upon the type of contract and depending upon the contract condition. But generally speaking, as a QS, whether you are from contractor or whether you are from client or consultant, what items you will see in the valuation? Can you comment, please? Preliminaries. What else? Measured work, provisional sum. I hope everybody can see this slide, right? Because somebody said that he can only see the first slide here. Can you confirm? Yes. So I think there might be problem with that particular person, but generally people are able to see this slide. The current slide is valuation and final account. So I see a number of responses. I think everybody has probably tried to raise one particular aspect of the valuation. Yes, you are right. So there will be preliminaries, there will be measured work, properly executed measured work. If the contractor has design responsibility, then there will be contractor's design portion, material on-site, and if allowed, material off-site, prime cost sums, provisional sums, variations, claims, advance payment and its recovery, retention, some other deductions or credits as the contract may allow, fluctuation. Now, not all of these elements will be in your particular project, but these are probably the elements which can be in a particular construction contract, and also milestone stage payments in some cases. Insurance becomes part of preliminaries, yes. So, as I mentioned, I won't be able to touch upon all the topics, but I will try to at least look at some of the key topics by asking questions to you only. So what are preliminaries? Sometimes they are called preliminaries and general matters. Indirect cost. Indirect cost. Okay. So preliminaries and general matters. Why they are called general matters? There is a reason behind it. Because you cannot allocate that particular cost to any particular piece of item. So you cannot say this cost is only related to MEP sanitary appliances, or this cost is only related to the site established initial work, not site preparation work. Let's say the superstructure or substructure work. So these are the reasons why they are called general matters. They are not included in the measured work item rate. Okay, so let's have a look. So items that are not directly related to any component, element, or any particular section of the measured work. Okay, so it can include all these items: management and staff, site establishment, temporary service, security, safety, environmental protection, cleaning, site services, insurances, bonds, guarantees. All of these will be included in the preliminaries. And why they are called preliminaries and general matters? Because they are generally related to the entire work. How would you do valuation of preliminaries in an interim valuation? Okay. Any idea? How would you do valuation of preliminaries? Somebody saying by completed percentage, depending upon GI type. Okay. Elapsed time, time-based, fixed-based. Very good. So there can be different ways of doing this, but there is probably a better way, and in some contracts there might be some other way specified. So first is obviously you need to read your contract, check the contract condition. It could be based upon a percentage of measured work. If the measured work is completed 50%, then 50% premium needs to be paid. But this is a very rough method, and normally we would, as a consultant, we wouldn't prefer this particular method. So the ideal method is, as some of you have identified, you need to sort of separate them into what are the cost related items, what are the time related item, what are the fixed price single payment items, or sometimes the items are combination of one or two or many of these. So time related item means as the contract duration progresses, you need to pay. For example, the running cost, it will be based on, if the contract is for 40 months, then the running cost will be divided into 40 months, and then you will pay probably that. Now you need to be careful. If the contractor is in delay, then obviously you are not going to do it that way. So you need to adjust those time related items in that case. Fixed price single payment means, for example, mobilization. If the contractor has completed the mobilization on site, then that particular cost head will be payable. If the preliminaries has a breakdown and there is a line item which says mobilization cost, once the contractor has completed the mobilization, you will pay for that cost. Similarly, there will be items related to cost. For example, the insurance cost, bonds, guarantees. Once the proper insurances are in place, once the proper bonds, guarantees are in place, that cost will be payable to the contractor. So this is a better way of doing it, because you are actually then paying at least when the cost is incurred. You are not paying on a rough formula basis. This is one of the questions which normally comes in interview. Many assessors like to ask this question. Would you pay for material offsite? What do you think? Will you pay? Yes, somebody is saying no. Somebody is saying I will pay if contract mentions. Yes, depends on the terms of contract. Okay, so good. That's some. There are some quality responses here. So first thing you need to check is contract condition. Does it allow for it? If the contract doesn't allow, then as a QS or as a contract administrator, you are not going to pay for it. Simple. Let's say if the contract allows for it, then there will be some specific approval requirements specified in the contract that take the approval from client. If there is nothing specified, then fine. But if there are any approval requirements specified, then you need to take that approval first. Normally, even if the contract allows for material offset, it won't be for all the items. It won't be for nuts and bolts and things like that, because they can generally be put in anywhere. Nuts and bolts are used for everything. So you won't be identify whether that particular material is for that particular job. Normally, it will be for big items. Normally, for offsite store, the items which are offsite stored. For that items, the material offsite is used. But generally, client will not like to pay for it unless they really have a problem with the storage on site. One of the most important thing is you will be looking for something called as vesting certificate, of if the title of good or the ownership is vested in the employer. After payment by the employer, will it be vested in the employer? At that point in time, it should be at least vested in the contractor from the supplier. And this is the point the assessors would like to listen here. The moment they hear that you mentioned about vesting certificate or title of the goods, they will be happy. Then also there are other areas obviously you need to look at, whether the material is stored properly, whether it is insured properly, whether it is protected properly. So all these items you need to look at, and whether it is clearly labeled. So if all these conditions are satisfied plus any other condition mentioned in the contract, then you would pay material for offset as long as the contract allows for it. And follow the valuation rules. The contract may say pay only 70% of the BOQ rate or 70% of the actual invoice cost, depending upon the type of contract. What is retention? Why is it held? What is retention? Now somebody is asking what's the difference between material on-site and off-site. By the time you comment on what is retention, I'll just answer that. Material on-site will be specified in the contract that this is client's premises or this is the site, and anything stored on this site or in the adjacent area of the site, which will be mentioned in the contract itself, will be treated as material on-site. And anything which is not there will be treated as off-site. So what is retention? Amount retained, yes. For what purpose? Yes, very good. So you know already, it's amount retained. It can be certain percentage. And why? What's the purpose of this? That client has some sort of security. Let's say the main contractor completes the job and there is no retention, and then there is a defect liability period of 1 year or 2 year, and he doesn't come back to correct the or rectify the defect, then the client, what the client is going to do, because he might have paid by that time for everything. So there is some money which is reserved or deducted from each monthly valuation or each periodic valuation. That money is retention. It can be any percentage. Some, mostly I have seen it is 10 percentage, but it can be any percentage. And it's an incentive for the contractor also to come back and rectify the defect. How much retention is held? Again, it depends upon the contract. See the contract condition. You should be thorough with your contract when you are going for an interview. So you will be able to mention very confidently that this was the condition in my contract. But generally, it is 5 to 10%. What items are subject to retention? Again, the contract will specify. Normally, I would say everything, including variations. If there are variations, once the variations are part of the contract sum, because the contract sum will be revised, and retention will be held on that. But if there is specific condition in the contract which stops from doing that, then that condition takes precedence. But otherwise, the everything will be subject to retention, probably excluding any fees which are directly paid by the contractor. So check the contract condition. When is the retention released? When is it released? Oh, that's a question asked by somebody, and then somebody is responding. Yes, somebody is saying after TOC, somebody is saying after DLP, somebody is saying 50-50. Again, check the contract conditions. Different contracts will have different provision, but generally half of it, let's say we say 10% retention, then 5% of it will be released after the certificate of completion is issued. So work is completed, and the remainder 5% will be released after the defects liability period or guarantee period, sometimes it is called, as expired. But the release of retention is different if there is sectional completion, partial possessions, or lying under the contract. So if there is sectional completion or partial possession, and the understanding of these terms we will be covering in our next two webinars, which will be on contract practice and contract administration. The next webinar will be on the next Saturday, the same time, 7 to 9, contract practice. It will be taken by Mr. Zia. We will be shortly, mostly tomorrow, we will release the flyer for that. So we will cover these topics in detail at that point in time. But if there is sectional completion or partial possession in the contract, then there will be different conditions of releasing the retention, because some retention might be released at these stages. Are there any alternatives, alternative to retention? Yes, there are alternatives. There can be retention bond, there can be retention guarantees, which contractor can give. Why he would do that? Because to improve his cash flow. So he doesn't want to sort of lock his money, the 5% or 10%. Sometimes on big projects, billion real or billion dirhams project, there might be a good sum of money which the contractor doesn't want to sort of lock in. So he will provide a bond from the bank, and he will get that retention. If there is any problem, that the client can pull the bond. So it is to ease contractors' cash flow. Now, what do you understand by prime cost sums? Some people have asked this question in comments before, I have seen. Okay, I'll explain. Looking at the time, what do you understand by prime cost sum? A prime cost sum are normally linked with what you call as nominated subcontractor or nominated supplier. So in the contract, there can be some subcontractors or suppliers nominated. Nominated means the client nominates them, that you need to purchase the material from this particular supplier, or you need to have this particular subcontractor as your subcontractor for MEP works, let's say. So in that case, any sums payable or paid to the nominated supplier or subcontractor are called prime cost sums. and you will need an authorized instruction to expend these prime cost sums. Now there is another term which is called as provisional sum. This is different from the prime cost sum. Provisional sum is provisional as the name suggests. So it is an amount which is reserved in the tender or in the contract for items which cannot be foreseen at that point in time, cannot be foreseen clearly or in detail. So there is a sum reserved based on some cost plan or some working by the quantity surveyor. So that sum will be expended once the things become clear, once the design is done. So that sum also will need an authorized instruction to expend. So it's sum included in the tender contract for work which cannot be entirely foreseen at the time of tendering and needs authorized instruction to expend the provisions. Again, some of these topics we are going to retouch in the contract administration section because that's where they suit more. But at least you should have, yes, defined provisional sum and undefined provisional sum. We will take care of that in the contract practice and contract administration section. So there is a difference between defined and undefined provisional sum. But any provisional sum which needs to be expended, you will need an authorized instruction from the client or whosoever is the authorized person mentioned in the contract. How would you check day work? What is day work? Why that is used? Any comments? Incidental work. What is incidental? Because that is the question which I would ask if I am assessor. Based on agreed unit rate, remeasurable quantity, minor works which is not quantified, unforeseen works. So there is confusion about what is day work, new work, prolongation, actual work, scope that doesn't clear on quantity, JMR. I don't know what is JMR. Okay, so day work is labor intensive. Sometimes it's good to see some of these comments. Okay, now what is day work? Day work is normally used for items or piece of work which cannot be measured, which is difficult to measure or cannot be measured with the existing rules of measurement specified. Okay, so it's difficult to measure. Okay, so it can be incidental work, but basically it's the work which cannot be measured properly. So how you will check the day work? First, you have to, if the contractor is coming to you and if you're a client's or consultant's quantity surveyor, then you need to first ensure that the work actually cannot be properly measured, because that's the basis of the what is something, why something is called as day work. And once you establish that, you need to also make sure that there is no overlap with measured work. You are not duplicating, you are not paying for the measured work, and this is some part of it which you are not able to identify. Okay, the method of valuation will be on prime cost. Now, what is prime cost? Prime cost is the actual cost of labor, material, and plant. And also, you will be paying the overhead and profit to the contractor. Now, you need to make sure that this labor, material, and plant is properly recorded on site. And there is a sign off by authorized representative mentioned in the contract. If you are not clear, if there is no clarity in the contract, then you need to discuss with the seniors or the client, like who would be authorized. It can be somebody from a construction supervising company, it can be somebody else. So all the labor, material, plant which is used for that particular piece of work, day work, will be recorded on sheets called as day work sheets, and it will be signed off both by the contractor's representative, the site representative, the management contractor's management representative, and also by the supervising consultant or anybody who is authorized in the contract to sign off those day work sheets. This is very important because a QS is not expected to change anything in the day work. Okay, a QS is not expected to negotiate. Oh, you are saying this much, I will pay you this much, because the day work is supposed to be the actual record of the labor, plant, material used. As long as that record is authorized by an authorized representative, then that record is the cost of the day work, which is very important. Unless you really smell something which is wrong, otherwise this is not negotiable. Okay, you cannot negotiate even if you are a client QS. So ensure that the time claim tallies with the, you will just do the checks that the time claimed on the valuation or on the application of invoice or application of payment is tallying with the timesheets. Okay. And similarly, you will check that the plant was only used for day work. Now you will check means the construction supervisor actually will check, because sitting in your office as a quantity surveyor, you won't be able to do that check unless that has been assigned as your responsibility. Fluctuation. Fluctuations. Now there are some fixed price contract and there are some contract which are not based on fixed price. Okay. So they allow the fluctuation. I'm not talking about lump sum. Lump sum is different. Fixed price and fluctuated. The price is fluctuating. The fluctuation may be only allowed for some elements. For example, if the market is buoyant, okay, if the copper price is going up and down, okay, in that case, probably people will go for fluctuation clauses in the contract. These fluctuation clauses will basically have a formula mentioned in the contract, how any inflation, for example, will be calculated on the base material price. Now, this can be done by two methods generally. One is in the contract itself, the base material price will be listed. So at the contract date, these are the base material prices of the key elements where the fluctuation is allowed. And then the actual prices, if they go up, the contractor will raise that the actual prices become 10 times more expensive or 20 times more expensive. He will provide the supporting documents behind it, and then the difference will be paid, which is inflation basically. There can be some other way. Sometimes people refer to the published indices in that particular country. Now, not all Middle East country have published indices, but that's another way of doing it. So that's fluctuation. So based on the formula, it can be basic list, labor cost, published indices. Claim. Okay, this is a big topic. Again, we will be touching upon this topic in few other sessions, and probably we might actually need to take specific sessions on claims, because a lot of people have misconceptions about a lot of things. So here I'm only going to talk about loss and expense claim. Have you heard about loss and expense claim? Any of you heard about loss and expense claim? Work which cannot be evaluated with available rates. Oh, that's previous answer, it looks like. Yes, heard, yes, in JCT contract. Loss of profit. Okay. So what I'm referring here is basically, okay, you must have heard about delay, right? Or disruption. Everybody knows about the project is delayed or project is disrupted as a result of variation, or as a result of the client has stopped permission or has not given permission on time, let's say. So there can be delays to the project, there can be disruption to the project. Any idea what's the difference between delay and disruption? See, I'm trying to touch upon the basic concept. That's why I'm asking these questions too. Yeah, disruption claim, what does that mean? Delay is lateness, very good. Abortive, demolition, disruption is hindrance. Okay. Loss of productivity, good. Disruption is loss of productivity. So sometimes what happens, because of the client action, the contractor's work is not really delayed, but it is made less efficient or less productive. Okay, so contractor has to put more resources to bring it back. So in that case, the disruption has happened, and then contractor may charge that to the client. Okay, the cost of that because of the disruption, what is the cost incurred by the contractor? So when I'm talking about loss and expense claim, I'm talking about the reimbursement of the loss or the expenses incurred by the contractor due to reasons such as delay or disruption. So why I'm only talking about loss and expense? I'm not talking about currently profit of contractor here. And I'll come back to that in a minute. Why I'm not talking about the profit. Okay. So let's have a look. So this area deals with the reimbursement of contractors' direct loss and or expenses, typically due to delays, disruption resulting from design changes, late instruction, etc. However, it does not always follow that delay caused by the employer to the project will occasion loss to the contractor. Now, why it is said? Not always the delay caused by the employer will result in a loss to the contractor, because sometimes the delay can be on non-critical activities. The project will actually be delayed if the critical path is delayed, isn't it? So That might be one of the reason. Simply because the contractor has received an extension of time does not always mean he will be entitled to additional payment as well. This is another aspect. If the contractor has received an extension of time, do you think that he will always be entitled to the cost? No. Why not? Now, those who are from contracting organization, they will, why not? Because the extension of time may represent a number of things. Extension of time, for example, there can be activities which are delayed by both the contractor and the employer. In that case, the contractor only gets time, generally speaking, unless the contract specifies otherwise. So if there is an activity which is delayed both by the contractor and by the employer, the contractor is not going to get benefited out of his delay because he has also delayed, right? So in that case, generally only an extension of time will be permitted, cost will not be permitted. There can be cases where the employer has completely delayed, then there will be cost will be permitted. There can be cases where the contractor has only delayed, there is no employer delay. I'm just taking some theoretical. In actual project, there will be a combination of all of these. So theoretically, let's say only contractor is delayed, so he doesn't get anything because he has delayed. Plus, if there are liquidated and ascertained damages in the contract, those will be applicable. Or if there are penalties in the contract for delay, then those will be applicable. So there can be different scenarios. So not always extension of time means there will be additional payment to the contractor. Also, always the losses will not be necessarily as a result of the extension of as a result of the delay, as just we saw. There can be disruption if the contractor's work is made less efficient, then as a result of employer action, then this is a case of disruption and not delay. So it's not a delay claim. So claims here are restricted to direct loss and expense, and so consequential losses are generally excluded. Now let's say that there is a delay. So the contractor will only be, and because of employer, the contractor will only be able to recover what is called as direct loss and expense. So whatever losses is incurred and the expenses he has incurred, it won't be allowing for consequential losses. He cannot say that I had some production factory there, and because of this project delay, I got delay there, and no. The losses will be direct losses. Direct means those flow naturally from the breach of the contract. Also, they should be in the contemplation of both the parties. Who both parties? The employer and the contractor. They should be in contemplation of both parties when the contract was placed. Okay, so they cannot be everything and anything. What basically this all comes from something called as a damage provision. Damage provision, which is not generally seen here. So the basic concept of damage provision comes from, for example, UK, where they have common law. Now, what that provision is, if there are two parties to the contract, if one party is in breach, then that party is liable for damages to the other party. But the nature of damages should be something which flow naturally from the breach of contract. You cannot ask for consequential losses. And also, what they are doing is, as far as money can do it, we are trying to put the aggrieved party, the party which has suffered, we are trying to put that aggrieved party back into the position where it was if that damage or if that breach didn't happen. Means what? If the delay did not happen, what would be the contractor's position? We are trying to put the contractor back into that position. It's like an insurance claim. If you claim for an insurance, what would be paid to you is what expenses you have incurred. They won't be paying you your profit on that. Okay, now why not profit? I'll come to that again, as I mentioned. So they won't be that claim won't be related to profit, but all this is related to what I mentioned is UK common law. Now in GCC or in Middle East, there are different countries will have their different provisions. Okay, so they will have their different provisions. There might be some civil codes, or different countries will have different provisions. Okay, so I'm not expert of all the provisions. I worked in UAE, so I know a little bit about UAE. I'm working in Qatar. I know about Qatar. I am not sure about all other countries, but those express provisions, if there are express provisions in the contract, how a loss and expense claim will be evaluated, then those provisions takes precedence on everything else. If there are no express provisions, then the second place to look at is the particular country's laws. Okay, if there is a civil code in a country, then that civil code will specify what will be allowed, what will not be allowed. Okay, and then if even that is not there, which is a rare thing, but if it is not there, then some general principles like principles from the common law will be followed. So it's that is important. Now let's see if anybody has raised a question on why not. Yes, somebody mentioned about SCL protocol. Yes, correct. That's a good document to read. Excusable delay, concurrent delay, etc. So let's come back to the question, why not profit to the contractor? Why is contractor working? Contractor is working to earn the profit, isn't it? So if there is a delay by the client, why the contractor should not be able to get his profit? Valid question. Okay, but what I mentioned is this particular provision is to put the contractor back into its position. Now imagine a situation that the project is over. If the project was to be over, let's say in 3 years time, and if the project doesn't get over in 3 years time and there is a delay, let's say of 1 year, so let's say the project goes into fourth year. But if there was no delay to the project, that contractor had no other job. Let's imagine he had only that particular project in that particular country, and after that project he was to demobilize all his resources. Then now putting back him into his position means what? Putting back him into his position is paying for the loss and expenses he suffered, because if there was no other project, he would have actually not earned any profit. He would have just demobilized all his resources. Okay, so that's why this is not, the profit is not generally included in a loss and expense claim. There is another heading through which the profit is introduced. That heading is called as loss of profit. Somebody mentioned about loss of profit before. So there will be a different heading, loss of profit. Why different heading? Because here the contractor needs to prove that if there was no delay, then he could actually win other project, or he was having another project on his list where he could put his resources and earn the profit which he has lost now. That's why loss of profit. So this is the basic understanding or the background behind why these claims are called as loss and expense claims generally. So other items which can be claimed in a delay or a disruption or loss and expense claim will be, normally you will be able to claim a lot of preliminaries items like the extended resources, extended preliminaries, extended insurance, bonds, cost, etc. So those will be there. Plus you can claim for the overheads, extended overheads. There will be site overheads which will be extended. There will be head office overheads which will be extended. There are also formulas for head office overhead, but normally as a consultant we would look for some sort of establishment of actual cost if the contractor can do it, which is a bit difficult, but with some sort of some degree of accuracy it can be done. So head office overhead, site overheads, if there is finance charges, for example, sometimes the contractor suffers for cash flow, then the finance charges also would be introduced by the contractor in a typical loss and expense claim. Let me just have a look at any specific comment with respect to this. Yes, finance charges. Yes, there are a number of formulas. Hudson formula is there. One of the formula. In UAE, even Professor Samartunga has its own formula. I know. So claims, loss and expense is again a topic where I can keep talking about, but we have limited time, so we have to cover other areas, and you won't be asked in so much of detail as far as this competency is concerned. So let's move on. Risk management, another topic. What is risk? What do you understand by risk? When we mention about risk, what is the understanding? An uncertain event, correct? Somebody mentioned. So risk is an uncertain event. We don't know, and something is going to happen or not. Okay, so it's uncertain. And then what is risk management? Again, management, the moment the management word comes, always anywhere in your life, it's about planning, organizing, directing, controlling. Slightly different words will be used. Sometimes controlling will be replaced by evaluating, etc. Okay, so risk management is a tool, is a proactive exercise which is designated to enable identification, analysis, and effective management of risk. So we will see the principles of provisional sums. Provisional sums we have seen before. Contingency, risk allowances, risk management technique, risk register. Normally there would be questions on this. So let's talk about the risk management or risk assessment process. So it normally includes, as we saw, risk identification. First you have to identify the risk. Then there will be analysis of the risk. Once you analyze the risk, then you can sort of rank the risk, put them into ranking order, etc. Then you need to decide the response to the risk. How would you be responding to the risk? And sometimes on big projects there can be some quantification techniques also will be used. What is risk identification? So what happens on a project is, normally at the start of the project there will be meetings between the different stakeholders. This can be pre-contract also and post-contract also. I'm particularly talking about post-contract. So there will be different stakeholders. Stakeholder means was everybody who has a stake in the project. So it will be the client, it will be the project manager, it will be the QS, it will be the design manager, contractor also might be included in that meeting. So there will be a meeting at the start of the project. There will be a brainstorming session. Everybody will be sort of allowed to speak, brainstorm, talk about the various risks they can identify. This is how it will be done. And the identified risk, if people think they are valid, they will be put it in a risk register. There is also a possibility right from the pre-contract stage, a risk register has been maintained, because the client side organization in the cost planning, etc., they will always already know in design planning that what are the typical risks which can occur post contract. So there will be something called as risk register. It's a register where the risk will be listed, the description of risk will be there, and a number of other items will be there. We will see an example of risk register in a while. So they will be registered in the risk register. Then there will be risk evaluation. Evaluation, first initially a qualitative evaluation is done, not a quantitative evaluation. A qualitative evaluation means at a high level, it is decided whether that particular risk is going to occur very frequently or less frequently. So the probability of the risk is decided, whether it will be, let's say, high, medium, or low. Sometimes it will be very high, medium, low, very low. So different people. So it's a qualitative, it's not quantitative. So a risk will be decided whether it is the frequency of the risk will be decided by discussions or the knowledge of the project team. So that's about the frequency of the risk. Then also, or the probability of the risk. Also its impact, whether it has high impact, medium impact, or low impact, that will be decided. So these two items will be decided. And then what you do is you try to uh, rank these risks. So how you rank this risk? By multiplying the probability with its impact. So you get another rating. So probability, let's say high, multiply by the impact, medium. So high into medium, you might rank it, you might give a number rank, or you might just say it's high. High into medium is high, like that. So this is how the risk will be ranked. So risk evaluation, it's qualitative, probability and impact, high, medium, low. Risk ranking will be done by multiplying probability with impact. Then risk response. Now how you can deal with risk? Now this is something I would expect from you. What response you can provide to risk? Manage, transfer, avoid. Good. Yes. So you can do a number of things with risk. The best thing is to eliminate the risk, isn't it? But sometimes to eliminate a risk, it would be very costly, or it would cause a lot of impact on time or other aspect, or sometimes it's not possible to eliminate the risk completely. So eliminate is one option. But if you cannot eliminate, you can obviously try to reduce it. If you cannot reduce, you can retain the risk. If you are employer, you can retain the risk. So you will have some budget associated with that retaining of that risk. If you want to transfer that risk to the contractor through a contract, you can transfer that risk. So risk of any poor measurements, or that can be transferred to a contractor. So if it is a lump sum contract, and if lump sum contract with a bill of quantity is presented, there will be a clause which says the bill of quantities are indicative only, and the contractor takes the risk for the quantification. Okay, so contractor has to price the correct scope based on the specifications, based on the contract condition and other documents, etc. So BOQ is only indicative. So the risk can be transferred to the contractor. Sometimes the risk can be shared between the employer and contractor. Some risk will be shared by the employer, some risk will be transferred to the contractor. If there is unforeseen ground condition, who takes that risk, for example? So the contract conditions will be drafted in such a way that risk can be transferred or risk can be shared to the shared with the contractor. So these are some of the way risk can be responded. So avoid, reduce, eliminate, transfer, share, tolerate or retain the risk. Risk quantification. Now only generally on major products risk quantification will be used. So this is to estimate the risk allowance with some sort of confidence rating. Monte Carlo technique and some techniques are used. I don't think you need to go into details of that. And the confidence, like it will be reported as with 80% confidence, we think that this is only for major projects. Generally, you need to know the risk management process, that it includes risk identification, evaluation, risk response, and risk quantification. And what is meant by identification, evaluation, and risk response? What are the various responses? If you say that much, I think that much is going to be enough. Now, again, I want to remind you that not all of you will be actually involved in managing the risk. In fact, most of you will not be involved in managing risk. The people who are at junior level, they may not be even aware of there is a risk register or something called. Okay, but as a QS who you want to become like MRICS, you need to have understanding of these concepts, at least as I mentioned in the first slide, what RICS expects from you. Contingency risk allowance. So contingency is basically a sum of money which is kept reserved for the risk, so that if those risks in fact actually takes place in the project, then that contingency can be used. So money allocated to unforeseen or possible additional cost, expended with the permission of the client. You cannot just expend that money. Normally it should be expended against the identified risk in the risk register, because that money is actually kept for that, not for everything else. So this is linked to risk register, and the value of this will be reducing or fluctuating during the life of a project, because generally it is expected that the profile of the risk will be reduced as you progress through the project. You will know the unknown things, and then either they will be converted through a change management process, there will be a variation, so that they will add to the contract sum, and the risk budget or the risk value will be reduced in the risk register slowly during the life of the project. Risk register, we discussed this. The risk allowance identifies risk and associated cost. This to be managed throughout the project life, should only be expended on the occurrence of the identified risk, and not simply, as I mentioned, not simply as a contingency. And as a risk is expended, again I mentioned this, the associated cost will move from the risk allowance into the outturn cost of the contract, and this will be controlled through the change control process. So there will be variation issued, for example. Here is an example of risk register. So I hope all of you can see this. This is risk register which is indicating some construction risk. So you can see there will be an ID mentioned or some sort of reference mentioned in the register for that particular risk. There will be a brief description of the risk, when it was raised, what's the impact, what's the probability, high, level, medium. M stands for medium, H for high, L for low. And then what the project severity, which is multiplication of the impact and probability. What are the mitigation measures? What is expected to be done to deal with that risk? Okay, and who owns that risk? Normally, who has initiated, probably he will own, or if there is a proper party, for example, if the risk is transferred to the contractor, then the contractor will own that risk. And if there is any adjusted impact afterwards, if it is thought that no, it is not a high sort of impact risk, it's a medium impact risk, then that is adjusted impact. This is a typical format. Different projects will have different format, but this is again indicating what should be or what will be included in the typical risk register. Value management, value engineering. Always there is a confusion between these two terms. There are a bit overlapping. Actually, value engineering, when you consider, it is part of the value management. Okay, I've quoted two definitions here so that I don't differ from what is need to be said. So value management is the wider term used in the UK to describe the overall structured team-based approach to a construction project. It involves clearly defining the client's strategic objectives, considering optimum design solutions within the context of client business objectives, and deciding which of these provides the optimum lifetime value to the client, as well as a review of the whole process after occupancy. Value management includes value engineering as part of the process. And what is value engineering? It's a systematic approach to delivering the required functions to the required quality at the least cost. That is a method of ensuring that the client gets the best possible value for money in terms of safety, performance, and delivery targets. Both definitions are extracted from the Surveyor's Construction Handbook. I'm 100% sure you have not understood anything by just reading this definition. Okay, so let me just simplify it. Value management is a bigger concept. It's a bigger high level aspect. It can include everything in the industry. Let's take a construction industry. So every process in the construction industry that can be looked at when we are looking from a value management perspective, or if the value management team is looking at it. All the processes will be looked at, all the procedures will be looked at. If there is an inefficiency identified in any process or procedures, that inefficiency, the team will try to reduce that inefficiency. So looking at the whole entire process of a construction industry or any industry, for example, is a value management process, and then trying to increase the value by optimizing the processes. Okay, optimizing the different processes. So this is value management. Value engineering is a small part of the whole value management process. So when we say value engineering, what we mean, this is typically related to a specific process or a specific product. For example, if you have a light fitting on a project, and if you can find another light fitting which can give you the same performance, say for example lux level for the light fitting, and which can also give you same aesthetic appearance or similar aesthetic appearance, and also which is lower in cost compared to the existing light fitting, then that's a value engineering solution. That's a value engineering proposal. So value engineering is actually a smaller part of the value management process. So as simple as that. Normally we will be dealing with the value engineering aspects, but I don't think you'll be asked very detailed question, because value engineering is something where not every QS will be involved into detail processes. What is the difference between VE and cost saving? Okay, VE is not necessarily cost saving or cost cutting. VE is maintaining the same function, same quality at the least cost. Okay, so that doesn't mean that you have to reduce the cost. If you see as a mathematical formula, within the same cost, if you can provide a higher value or higher quality to the client, or higher function or better function to the client at the same cost, it is still value engineering, because you are increasing the value. Within the same cost, if you are providing a better product, then that's increase in value. So it's not always cost cutting or cost saving. Okay, who should initiate it? Is it the responsibility of QS? No, it's not. Value engineering not necessarily responsibility of QS. It will be through a value engineering workshop. The workshop will be normally chaired by somebody who is expert in that. There are expert people. People from outside may also be called to chair the workshop, or project director, for example, or a design manager can lead the value engineering workshop. Now, what happens in this value engineering workshop is the different stakeholders, again they will be gathered, and if there is a need, then again they will be discussed some of the principal cost components or high value cost components, or any components where they feel that value engineering is required. So again the brainstorming will be there. Normally there are phases like initial phase where the brainstorming sessions, initial phase where the ideas will be initiated. So ideas gathering phase is there, and then there is a brainstorming session, and through that session, the ideas which pass to the next stage, those will be evaluated, and those evaluated ideas will be then presented to the client or presented in a workshop to everybody. Normally that is done by the person chairing the value engineering workshop. So this is how value engineering done. The role of QS in this particular aspect would be to look at the commercial aspect of the value engineering. So if the designer has suggested some value engineering options, normally a QS would be asked to compare the two options. If we go with the existing specifications, what would be the cost? And if we go with the value engineered specification, what would be the cost and program impact if there is planner involved, let's say. And then what would be the saving in terms of cost, or how the function will be raised, that the designer would be sort of explaining. Okay. But it's not cost cutting always. So that can be a question in an interview. Does value engineering always mean cost cutting? No, not necessarily. Benchmarking best value. So benchmarking or best value is, again, I have quoted two definitions here: the overall process of improvement aimed at providing better value for money for our employers, and a systematic method of comparing the performance of your organization against others, then using lessons from the best to make targeted improvement. Now this definition of benchmarking or comparing with best value. So compare with the best, where your organization is and what improvements you can do to better your performance. Okay, so that's benchmarking in general. What is the meaning of benchmarking? For QS, some QS who have worked on cost plans in the initial stages or pre-contract stages, they might have heard a similar term called as benchmarking, or we are benchmarking from this project. So that term is slightly different. That term means what? For example, if you have an inquiry, if you are going to sort of prepare a cost proposal or a, let's say, cost plan, initial cost plan for a new hospital, elemental cost plan, let's say, and then you already have an existing data from other cost plan, for a hospital or other project, hospital project which has been constructed, or there is a contract sum analysis available. Okay, now you can use that data to estimate the cost of the new hospital. Obviously you will be comparing different aspects. Is it comparable, first of all? And if it is comparable, then you will be adjusting the cost data for various reasons, such as if the area is different, how the cost should be adjusted, for inflation or deflation, whether the cost should be adjusted. If there are other aspects, qualitatively the cost should be adjusted, whether the project scope is almost same, or if there are other aspects which needs to be adjusted. There are a number of adjustments which need to be done. So that is also called benchmarking. Okay, but this is what I have quoted is the general understanding of benchmarking. Best, compare with the best, see the variances and try to address those variances, try to better the value. So that is what is understanding of benchmarking. And now we have reached to a section of the session today, where I'm going to tell you what expected questions can be there in an interview. Now, when I say what expected questions can be there, please try to understand the questions will always be based on your summary of experience, what you have mentioned in your summary of experience, because that's your submission. Before, there was a time when assessors were asking theoretical questions which are not really necessarily related to the candidate's experience. RICS discourages that practice. RICS expects all assessors to ask questions from the candidate's summary of experience. However, the candidate also cannot just mention only few things in his summary of experience, because as I mentioned in the first slide, in your summary of experience, you need to cover a number of points, what is expected by RICS. Because otherwise, if you say, oh, I never worked on anything which is post-contract cost control related, so I cannot really fill in this particular summary of experience, then that is not going to be an acceptable response. So on other projects, you should be aware of the principles in general. If you haven't worked on a specific post-contract duty, on your specific project, you should be aware of the details of your project, detailed understanding how it operates, etc. That is expected, even if that is something you have not written your case study. But in your summary of experience, you need to touch upon the main points. So generally the questions will be typically worded as this. I see from your summary of experience that you were involved in taking measures to effectively control cost during construction phase of the XYZ project, whichever project you mentioned. Can you tell me what measures you took? Now, before going to the answer of this question, what I am trying to infer here is, when you are writing your summary of experience, be careful. There is going to be a question asked about that. So There are some people who are generally including everything in their summary of experience. For example, in contract practice or contract administration, there is an indication by RICS that these are the type of contracts. There is NEC type of contract, there is JCT type of contract, there are partnership contracts such as PPP. All this is mentioned. There are PFI, etc. So some people they just write yes everything. Yeah, I know about this, I know about this, I know about this, and then there will be a question asked. Okay, so you have mentioned that you are aware of the NEC contract, so can you tell me about this particular provision under NEC contract? Now here you get caught, because if you haven't really worked on NEC contract, then you should made it very clear in your summary of experience, so that the assessor will not ask detailed questions about it. So if I am there and I never worked on NEC contract, but I work only on FIDIC contract, which is mostly used in Middle East, FIDIC contract will be the basis. Generally, the contracts will be bespoke, but the general conditions will be from FIDIC, or there will be some changes made by the client in some of the general conditions, but mainly it is based on FIDIC. For most of the people, I'm sure some other people will be working on different types of contract. So what is important here? I will write my majority of experience has been working on FIDIC based bespoke form of contracts. Then I'll write what are the experiences I had on that FIDIC contracts. Okay, what are the aspects I have covered in the FIDIC contract? I will only mention that I am aware that there are other type of contracts such as JCT, NEC, PPC, 2000, etc. I'm only aware of it. Okay, so don't write something which you don't really know much about it. Okay, this is how the experience summary of experience should be written, so that they cannot ask you questions. Generally, assessors won't ask you a question if you have not worked on JCT contract. So they won't ask you questions about the JCT contract. Now, I'm not going to answer this question because actually we have covered this question in one of our competency slides if you take. So I'm just going to mention the second and third question. What is cost control as opposed to cost reporting? Again, we covered this. What is the aim of cost reporting? Why is it important to have financial reporting and control procedure? Again, we covered this in the competency slides. How did you report forecasted cost throughout the life of the project? We covered it through the financial or cost reports, monthly cost reports. What was included in the monthly cost report you were submitting to your client on the XYZ project? Now, I've given you a typical format of a monthly cost report. How does it look like? If you are really working on a monthly cost report, then you can obviously code what was included in your particular format. Okay, but be ready to explain the terms if they are asked. Why is change control required? Again, we covered that. What information did you include in a change control proposal, change request, change control form on the ABC project? Again, this will be always worded in such a way that when you were on this project, what you understand from this. When you were on this project, how did you do this? That's level 2. And when you were on this project, what advice you gave to the client, or how did you advise your client? So that's level 3. How did you actually implement the change control procedure? Again, I mentioned that. What issues did you consider in advising your client on change control strategies? Again, we considered that. You mentioned in your case study that you were involved in preparing monthly valuation. What was generally included in your valuation? Again, you can tell what was included in your valuation. If prime cost sum was not there, then don't mention it. Okay, otherwise they might ask questions about prime cost sums, for example. What is retention? We covered that. What are the alternatives to it? Retention bond or retention guarantee? What do you understand by the term retention bond? It's a follow-up question on the previous question. Is the retention percentage same? Again, a follow-up question they will ask. When would it change? The defect liability period and this certificate of completion, obviously. Did you hold retention on everything? Again, look at your contract specifically what it says about retention. If nothing is mentioned, then it is expected that it is held on everything. What advice would you provide your client if it decided to pay for material offsite? We covered that question. You mentioned in your summary of experience that you dealt with claims on XYZ project. What type of claims were there? So this is a typical question. If you have mentioned about claims, then you need to be aware of what claims you are mentioning and the background, a bit of background of those claims and how normally you would assess those claims. What do you understand by risk? Yes, it's an uncertain event. What was your role in review of the risk register? You mentioned ABC project. Now you may not have any role. If you have mentioned that you had some role, the role might be just looking at the cost of the the cost associated with the different risk mentioned in the risk register. Then you can mention that. From your experience, what key risk will you consider at the start of project? So what key risk you will consider at the start of project? Can you comment? At the start of project, construction risk. Yeah, what key risk? Yes, ground condition, authority restriction, soil condition. Yes, unforeseen ground condition is one of the typical sort of risk which might be encountered on the project. Second is there might be delayed instructions by the client or delayed instruction from the consultant. So these are the typical. Now here they are trying to look for your experience. Have you actually experienced it? Have you taken a note of what key risks are there at the start of the project? So this is typical level 2 question. How did you advise your client on XYZ project in assessing and managing the risk? We covered that in risk management. How did you use Dayworks to value variations on ABC project? We covered that. What information did you include on the Daywork sheet? We covered that. What's the difference between value engineering and value management? We covered that. So now I'm ready to take your questions. We have only 15 minutes left. So now is the time to ask questions. So let me see if I missed any questions before. Kindly explain the difference between bonds and guarantees. Yes, I will explain this difference. In fact, once we finish all the technical competencies and mandatory competencies, what we are going to do, we are going to touch upon some important topics. For example, bonds, guarantees, insurance, warranties. This is an area, again, people are confused a lot. And there will be at least 1 hour session on insurance, bonds, guarantees, warranties. Similarly, there is this claims area where people are confused. So there could be a session on that. Cash flow. I'm not talked a lot about cash flow because there was a time limitation also. So cash flow will be a different session altogether, because on cash flow at least 1 hour needs to be talked, because there are so many aspects of cash flow on which the questions can be asked. Okay, so what we have done today is try to cover as many aspects as possible to the level of detail I can within the given 2 hours time. What's the percentage of tolerance while valuing variation prior to instructing them? I really didn't understand what you mean by tolerance. If the project has been suspended due to client's default, what will be the contractor's eligibility for loss and profit? If it has established that it was suspended because of client's default, then again you need to follow the contract condition, because that will give an indication. See, in construction, specifically in contract, because I'm dealing with arbitration in London, I know that most of the time a general advice is not applicable. It depends upon your contract condition and what it specifies. Because I have seen different contract conditions will have altogether different conditions, and the way to deal with it will be altogether different. How to charge variations? Variation may affect cash flow, so should there be any limit to variation percent mentioned in the contract? No, not really. The variations, I don't know from which perspective you are asking the questions, but variations will be instructed generally by the client, isn't it? So the client will decide if he wants to limit the variation. Obviously, every client will want to limit the amount of variation. But if the end user requests something that needs to be done from a functionality perspective, then it needs to be done. So that client will decide. Normally, contractor would be costing these variations. Variation evaluation when BOQ quantity and actual as per contract document is different will be covered in the contract practice and contract administration. Daywork need a special Daywork instruction. Yes, if the contract doesn't specify about Daywork, then a specific Daywork instruction will be required. Normally contractor would shouldn't take the decision on its own that I will value this work by Dayworks. Cash flow is based on Primavera P6 cost loaded, or should it be based on invoice based? The cash flow will be, again, if this is a cash flow submitted by the contractor normally would have some sort of software. Okay, but ideally it should be based on the realistic a projection of realistic cash which will be expended on the project. Okay, so a lot of people are using software. Basically the what the software does, it requires minimum input. What's the contract value, what's the contract duration, and normally then it will plan on a S curve. Okay, but there is no it's not necessary that this is exactly how the cash will be expended. Contractor probably is in best position to decide like when the materials will arrive to the site, so when he will invoice and when he will the client will require to pay him. So it is based on the contractor's program, and ideally it should be done, if possible for small projects definitely it's possible, it should be done manually. Okay, but for larger projects I know that they are using Primavera P6, all these softwares. Could you please provide a simple explanation for consequential losses? Consequential losses. The word consequence means effect. So uh, because of a breach of a contract, if there is an indirect effect, then that indirect effect won't be paid. As I mentioned, the contractor can claim for the losses naturally coming from it. For example, as we said, that if there is a delay or if there is a disruption, then that inefficiency cost the contractor will claim for that. Or if there is a delay, then the extended resources he can claim for that amount of duration for which he has been certified that yes, client has accepted that it has been its delay. But contractor cannot claim big that delay, that cost, as well as because of this delay I couldn't do something on other project, so that cost he cannot claim. So consequential losses he cannot claim, or loss of production in some cases somewhere else, then he cannot claim that. If cost report mentioned actual cost more than the budgeted cost at any time, what remedial actions QA should take? See, this is from Sanjay Chawla. If cost report mentioned actual cost more than the budgeted cost, there is a possibility. See, the purpose of the cost report is not to hide anything. The purpose of the cost report is in fact to make the client aware as soon as possible of these type of situations where the cost is exceeding. Now, what measures a QS can take? The QS can discuss with the client, the key personnel with the client. One of the measures can be value engineering, for example. People can look at the aspects of some of the major cost components, and then they can decide whether they want to go for value engineering. But if that is the case, when the budget is a constraint of the client, that's a call which the client needs to take. So that's one of the things which can be done. Please, can you brief how disruption can be demonstrated effectively? This is a contract administration question. We will be covering that in the next two topics. But basically for disruption, it is a bit difficult how to sort of claim it effectively, because you need to sort of demonstrate that what would be the cost if the disruption didn't happen, and what is the actual cost because of the disruption. Now, actual cost is actually easy to demonstrate because you will have probably some records of actual cost. Okay, but what would be the cost if disruption didn't happen is a question which is difficult in this particular case. So there are various methods that there will be estimates made by the contractor. Normally this activity would take this much time. Contractor can use his base program to demonstrate that. That's main tool. But there are other methods like the time lapse, the not time lapse, the time method where the time is compared basically, uh, and few other methods that we will, if we can touch disruption. I'm not sure whether Zian will be able to touch that, but if we can touch, we will be touching that again in the contract administration. What is non-scope variation? Yes, I mentioned about non-scope variation. Sometimes there is a legislation change, so it's not a scope change. The change happened in some law, and because of that the project cost has increased or decreased. Okay, so that is a non-scope change. Sometimes there are only the scope has not changed, but the provisional sums have been instructed. So the scope hasn't changed, but there is still a variation. Yes, mile measures is universally accepted. But these are very theoretical methods. In a real construction project, it becomes very difficult to touch upon these methods. If coating of DI pipe is omitted as it is not required and does not reduce the function, is it a value engineering or a cost saving? Whether it is a value engineering or cost saving, that for this particular aspect, this is a question to a designer actually. By what you have mentioned, it looks like it's a value engineering, because you mentioned that it's not reducing the function, so you are maintaining the same function at a reduced cost. Yes, value engineering should be performed as early as possible in the project. Not necessarily it has to be post contract. In fact, it should be as early, value management also, as early as possible in the project. What else? We still have 5 minutes. Let me just have a look. As a consultant QS, how can we certify staff mobilization under prelim? Again, if the contract specifies there is a staff mobilization as a line item and there is a cost associated with it, and the mobilization is completed, then you will be, after completion of that particular activity, you will be paying it. If the contract doesn't have a breakdown, then that's where the problem occurs actually. Now how you will do that? Okay, so that's why it's important that at the start of the project itself, there is a sort of some leeway where contractor QS and consultant QS, they can sit down and they can decide how to value some of these items. So you can progressively value some of these items. You can assign some value to these items also by doing some estimates. Can value engineering be initiated by QS? Yes, but generally this is something which is initiated by people who are from design management or design engineering background. Okay, but yes, as a QS you can. For example, on one of my project, we have initiated value engineering because there was a big problem because of the lighting cost, and then it became to some extent our responsibility, because we initially sort of priced those lightings, and it looked like when the proposals came out from the contractor, they were much higher than what we thought the price of those lightings would be. In that case, because of the, to some extent because of the politics, it became our sort of our headache, or our responsibility to look at that. And that time we initiated value engineering proposals for the lighting. So it can be done, but generally it is through a workshop. As I mentioned, it's not just one person's decision. Through a workshop, yes, you can put your opinions. Can Daywork be converted into measured work by preparing cost impact assessments and get approval? Normally, the term Daywork is not really meant for measured work. Daywork only comes into effect, or the term comes into effect, when you can actually not measure the work by the established method of measurement. How much variation can be allowed from original BOQ? There is no such typical answer. Okay, so if you are from a client organization, the client would probably decide, okay, how much variation can be allowed. Probably the client doesn't want to have too many variations, but then that depends upon his expectations of the quality, etc. Any examples of work that can be measured with regards to day works? Demolition work is one. If it can be measured, we will not call it day work, because day work is not something which can be measured. How to deal with prime cost sum? It will be based on the prime cost, means actual cost of the labor, plant, material. So if it is a nominated supplier or subcontractor, then it will be the cost of that supplier or subcontractor. Nominated means the client is nominating it, right? Could you share the slides with us? As we mentioned, the slides won't be shared, but I am recording this video, and hopefully if everything goes well, then this video will be available on YouTube. There is a channel, MEQSA, Middle East Quantity Survey Association, MEQSA YouTube channel. on which this particular video will be uploaded. Examples of work which can be measured, there are so many, isn't it? So you take any method of measurement, CSMM3, POMI, everything, almost everything can be measured. So these are the examples of method of work. So if you are talking about pipe, and if you are talking about how to measure the pipe in SMM7, then there is a method specified in the SMM7 how it will be measured. So you will be measuring the diameter of the pipe, and then you will be measuring the length of the pipe, etc. And then what other items will be included in the rate of that particular item. What's the difference between liquidated damage and liabilities? Two different terms. The liquidated damages, LDs, or sometimes they are called as LADs, liquidated and ascertained damages. Why the word ascertained is used? Because they are supposed to reflect, liquidated damages or LADs are supposed to reflect the genuine loss which the client would incur if the project delays. So normally they would be specified per day the contractor needs to pay this much cost, or contractor is liable for paying this much cost. So liable is a general term. It has a general meaning that he is liable for paying this much cost. But liquidated damage are supposed to be, not supposed to be penalties, but they are supposed to be, theoretically at least, they are supposed to be the pre-genuine estimate of the likely loss client is going to incur. Difference between variation and varied works. Variation is variation order, for example, which is issued. Varied works is varied works. So work is varied and then the variation order will be issued. Can engineer hold or not certified the time related preliminaries if the contractor delayed in progress or what? Okay, a bit tricky question. To some extent, yes. If the contractor has delayed and he is not on the project schedule, then obviously the time related charges won't be paid. So if the project was supposed to be covered in 4 years and now it's going to be covered in complete in 5 years, okay, then obviously the QS will try to hold, because in 4 years if he expend all the preliminaries, time related preliminaries, then for the last 1 year there won't be anything left. So again, the contractor will not have any incentive to complete the work. Or if the contractor is terminated for some reason, then there won't be any money left in the contract to pay for the new contractor who will try to finish the work. Okay, what's the difference between idle cost, prolongation, EOT? EOT stands for extension of time. So it's extension of time. That's all. Prolongation generally is used for the cost associated with the extension of time. And idling time is the idling labor or idling plant time, which can be used in disruption claim, for example. On what basis LD is decided? The client organization will be deciding the LDs. So if they are running a school, and if the school is delayed for 1 year, for example, so what would be the cost which client is losing? The cost of what revenue he will get from the school. Or if there is a hospital, then what revenue he will get from the hospital in that 1 year. Okay, so then he can decide per day how much he will be losing, and there will be a cap to the LDs generally, 10%, for example, typically of the contract price. What else we have? Okay, the time is almost over, and I know for some of those who have even joined from India, it might be quite late now. It might be 11:30 in the night. So I'm going to stop in a minute's time. I'm sure the questions will keep on coming. Some of the questions you can raise on our group, the Middle East Quantity Surveyor Association, MEQSA group. And please, I will sort of post something tomorrow. So please give me feedback of how you find this session on the LinkedIn, because I'd be eager to receive your feedback as I received in the first case. And I'll definitely post the link to YouTube link for this recording if the recording is successful. And then that will sort of serve, if you want to look at the slides, that will serve the purpose. So I would say good night to everyone. Thank you for attending. And don't forget that we will have a next 2 sessions on contract practice and contract administration topic. which are very interesting topics. Mr. Zian will be conducting these sessions, and hopefully tomorrow we'll be able to post the flyer of these particular sessions. So thank you for attending. You have attended in a very good amount of numbers have been, yeah, we have very good amount of number of people who have attended. Thank you and good night. I'm going to stop sharing the screen and I declare that this session is over now.